You need to go outside.
I know. Cheryl wants a minute.
Okay.
I need a minute.
It's not really 6 yet,
I'm still
according to my
downloading.
iPhone. We can always ask the prosecutor Turner what time it is. He knows. We want an opinion.
Because I'm not getting any
Opinion on
kind
what?
of
I'll give you
internet
an
reception
opinion.
here once again.
That happens to me a lot, which is why I grab the handy dandy sheet of paper as we walk in.
I had forgotten to charge this. The children hid my charger and cable. Oh, there we go.
I wish I have no children to blame. When I can't find my charger, it's my fault.
Have them.
Eventually, in like
dog.
50 years, I'm going to run out of kids to complain about what.
Spoke.
Okay, let's see if this works.
Everybody ready?
Yes, thank you.
Okay. I'm going to declare it 6 o'clock, and we're going to ask prosecutor
We're gonna
Turner if
pretend
he
it's
has
6
opinion
o'clock
on that.
now.
But we'll call this meeting Wednesday, July 15th, 2015. Ways and Means Committee to order, and we'll start with the Pledge of Allegiance to the flag of America.
pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, roll call, please.
Crawford,
Here.
Klaus,
Here.
Wheelock,
Yes, ma'am.
Kropa,
Here?
Max Bauer,
Here,
Lathrop,
Here.
and I show Johnson is excused.
he is.
Okay.
Be that long.
Then, are there any changes to the minutes of the last June 17th, 2015? If so, if not,
I do have a change.
do you?
Yeah, I remembered.
All
My
right.
apologies for my brain this week. Under the minutes, is this the right minutes? Nope, it was a change on the public health and safety minutes. My bad. Go
Okay.
on.
So if there are no changes, they'll be accepted as listed on the document. Now it's our time for first public comment. And go ahead.
Yes.
Any person shall be permitted to address a meeting of the Board of Commissioners, which is required to be open to the public under the provision of the Michigan Open Meetings Act. Public comment shall be carried out in accordance with the following board rules and procedures. Any person wishing to address the board shall state his or her name and address. No person shall be allowed to speak more than once on the same matter, excluding time needed to answer commissioners' questions, if any. The chairperson shall control the amount of time each person shall be allowed to speak, which shall not exceed 3 minutes. The chairperson may, at his or her discretion, extend the amount of time any person is allowed to speak. Public comment will be solicited during the 2 public comment periods noted in Rule 5.4, Order of Business. However, public comment will generally be received at any time during the meeting regarding a specific topic currently under discussion by the board. Members of the public wishing to comment should raise their hand or pass a note to the clerk in order to be recognized, and shall not address the board until called upon by the chairperson.
Okay, is there anybody in the public that wishes to make a comment? Please don't be shy. Doesn't look like that, so we'll close public comment, and we're going on to the agenda. Is there anything, does anyone want to add to the agenda? Commissioner Max Bauer.
Mr. Chairman, I would like to add a request for an expert second legal opinion regarding the 911 surcharge.
Where do you want to put it?
Under new business, please.
Okay. Attorney, now do we have to vote on that?
When it comes around.
I mean, when to add it to?
Oh,
Add it
yes.
to the
Okay,
agenda.
so do we have a,
We do.
do we have a second?
I'll second.
I have another addition to the agenda.
Okay,
I'll second hers.
want to do that?
I'll second hers.
I don't know what hers is
Discussion on
yet.
it? Okay.
Well, no, actually, you wait till all the additions are made, then you approve the agenda or don't approve the
Oh,
agenda.
okay.
So it won't be a full agenda to vote on yet until I add
Okay.
something, and then,
So we've got a first and second on Bob, and what would you like to do?
well, I'm going to loop on to that first and second by adding something else to the agenda, which is under new business number 2, a very quick thing for the NER Advisory Committee appointment.
Okay, is there a second to that?
We're already
Okay,
done.
all right. Any discussion? Okay, all those in favor say aye.
Aye.
Opposed? Okay, passes. All right. And then consent calendar is next. Sarah?
The purpose of the consent calendar is to expedite business by grouping non-controversial items together to be dealt with by one commission motion without discussion. Any member of the commission, staff, or the public may ask that any item on the consent calendar be removed and placed elsewhere on the agenda for full discussion. Such requests will be automatically respected. If any item is not removed from the consent calendar, the action noted, receive and file, or approval, is approved by a single committee action adopting the consent calendar. All information identified on the consent calendar can be viewed in its entirety at www.grandtraverse.org. A, receive and file. No items listed. B, approval. 1, Health Department Mutual Assistant Agreements.
Okay, does anybody want anything withdrawn from the consent calendar? Public? Okay, do we have a motion on this then?
Mr. Chairman, I move to approve the consent calendar as provided.
Is there a
Support.
second? Okay, any discussion? All those in favor say aye.
Aye.
Opposed? Passes. No special order of business. No items removed from consent calendar. Department action items. Finance Administration. I guess that's you, Dean.
Okay, we'll start off on page 16, actually page 17 is your general fund trial balance through 6 months of your fiscal year. If you turn to page 18, I'll be brief in my comments because I know we want to spend some time on our audit report, but the most significant item in terms of our revenue, just to comment, it's the second item that's listed, our Register of Deeds revenues from real estate sales and the transfer tax. We're having a very good year. The revenues are up $91,000 over the same 6 months a year ago. And, you know, we're always conservative when we prepare or project our revenues, but that's I think, a significant item that I did want to note. So real estate sales and activity are very, very strong at this point. So I really don't have any concerns with our revenues at this point in time. Obviously, the trial balance is showing, you know, a negative cash position, and revenues are trailing expenditures, but starting July 1st, we're collecting the tax revenue, so the trial balance will look much better in the months ahead. On the expenditure side, I've explained the variances. Most of them are, there's nothing that's out of line with the budget. Obviously, we moved central dispatch to a separate fund, and that's one of the main reasons why the public safety expenditures are lower. And then the balance of the variances are primarily timing differences regarding when we're recording our appropriations to the other funds. Everything is tracking well within the budget. We're actually a little under budget, which is a good thing on the expenditure side as well. So I have no concerns with our budget at this point.
Okay. Any questions of Dean? Okay. Do we have to make a motion to accept that report? Okay. Then budget amendments, we talked about that.
Yeah, I'll just present the budgeted amendments. We have 3. We did receive some additional revenues in our central dispatch fund, which we're budgeting to cover a piece of equipment that was approved. That's in the amount of $7,300, so that's a good thing, additional revenue to cover that expenditure. In the Parks and Recreation Fund, Fund 208, using the fund balance to cover the cost of the Kids Cove demolition. Actually, our costs there with that project are a little bit higher than we expected, and I'll have another budget adjustment next month, but that project is just about complete. So, and I think Danny said that, I think next week they do expect to have that site completely cleaned up and looking pretty good. So, and then the last item is to cover the replacement of the compressors at the Hall of Justice, which the board approved last month. So those are the budget amendments that I'm requesting your approval on.
Okay. Do we have a motion then?
Mr. Chairman, I would move to approve the budget amendments as outlined by the Finance Director.
Is there a second?
Second.
Okay, any discussion? Go ahead.
Dean, did we contact MMRMA to find out whether or not we had insurance on those chillers?
I have made a call to them, but we're kind of playing phone tag. I don't have an answer on that at this point.
Just
It would ultimately, though,
Makes sense.
depend on the reason, and we don't know why they, ceased
Yeah.
operating as they should. We won't know that, if you recall, Danny said, until we actually get into the replacement and get them down off the roof, so. But no, there's always the possibility, I guess, that they were, struck by lightning or something like that.
I would just suggest we put them on notice that we may have a potential.
Well, I have made that.
You know,
I
and
actually
I-
have not filed a claim, but I have put them on notice.
Put them on
so-
notice, exactly.
Any other? Okay, all those in favor say aye.
Aye.
All opposed? Motion carries. Okay, what's next? Tuition reimbursement limit?
Yes, I had a request from an employee to take a look at our current limit on our tuition reimbursement policy. I provided the actual policy, which starts on page 23. We do have a tuition reimbursement program that allows employees to further their education. The current cap on their reimbursement is $3,500 per year, and then the actual reimbursement is 75%, provided they have the appropriate grades, and we would pay 50% of that amount when they sign up for the class, and then the remaining 25% upon completion with a satisfactory grade. But we have not increased that limit since in a long time. And the request was, the cost for these programs, if you're taking a full load, has obviously increased over time. And the current IRS limit, in terms of the amount that's excluded from wages, which would mean that if we reimburse an employee for these costs, it's not income tax to them. And I'm asking for consideration to increase that reimbursement to $5,250 per year, which I know that's a substantial increase. But if you look at page 23 of your packet, which is also included in my recommendation, it is subject to or contingent upon the amount that the board approves in the annual budget. Obviously, at $5,250, there are not many people that would benefit if they, were taking as many classes as they could. We do limit this to the amount of funds that the board budgets for this program. It's a general fund line item in the human resources budget, and that would be my, recommendation for consideration would be to increase the limit, but the policy doesn't change. It's still subject to the annual appropriation of funds. If you budget $15,000 or whatever the amount is, when we hit that amount, the tuition reimbursement stops.
Okay. Any comments? Yes.
Approximately how many staff members are using this service?
I don't have the answer to that.
Are we expending the money that's been budgeted over the last couple of years, Dean?
No, in earlier, going back a few years, we were budgeting a higher amount, as much as $20,000, but the use of this program, for some reason, the last few years, we've stayed within that $15,000 limit. And Commissioner, I apologize. I should have done some homework on that.
Well, Sonny's question answers it in the same way. I mean, is it something where we have people that are knocking down the door and not hitting the deadline to meet the amount budgeted, or?
The amount at the $15,000 level has been adequate for the last 3 years. If you go back 4 and 5 years, we were between $15,000 and $20,000 on the annual request. But we have obviously reduced it down in the annual budget based on, the use, and, at any point in time that could increase. But again, it would be subject to whatever the board approves in your annual budget, so.
Is this limited to education that revolves around their current position with the county, or is this any education anyone wants to seek to move on and get a different job somewhere else?
Well, it should be related to their job, but it's also worded, if you read through the policy, it would be any other job that they could potentially apply for within the county. I mean, you shouldn't be out there doing something that's totally unrelated to your current job or to some other position that you might be qualified to, transfer to or consider if, the opportunity came up.
Is there oversight committee on that or something, some sort of policy?
They're reviewed by the Human Resources
Okay.
Department, and then I have some involvement in that as well regarding the approval.
Anybody else? Yes.
So I looked up what a credit hour costs at NMC for Grand Traverse County residents, and it's $96.35 per hour.
Yep.
So if they take, say, a 15-hour load, it's about $1,500 to do that. And if they do 2 semesters, yeah, they're going to hit, they're going to hit the cap pretty quick if we keep it at the lower one.
I think where you're really hitting that higher amount is if you're in the graduate level
Right.
courses,
Those
where
are higher.
the cost increases
At the university center?
substantially.
It doesn't have this here, but yeah.
Yeah.
I was just
And
going,
that's
just
different
for
for
something for
college, too.
reference, yeah.
Anybody else?
I guess the comment would be that we can, this raise to the $5,200 number meets the IRS requirement, but if we still continue to only budget $15,000, there's only $15,000 available.
It's 2.6 people.
So,
Well, to get full.
Mr. Chairman, I would move to approve the increase of the tuition reimbursement to the $5,250 as outlined by the finance director.
Is there a second?
Support?
Commissioner Crawford, any more discussion? All those in favor say aye.
Aye.
Opposed? Motion carries. Okay. Now, I think it's item 4, comprehensive annual financial report audit. I think that's Mr. Peacock.
Right, and I'll introduce our auditor. No, come on up, Steve. You don't need to be that formal. Steve Peacock with Raymond is here to present our 2014 audit report, or I like to refer to it as our comprehensive annual financial report. I did submit the report to the state of Michigan by June 30th. It's required to be filed with them. Hopefully our goal down the road is to actually have this meeting with the board prior to that submission. But when we include the road commission and when the pavilions is included too, it's just almost impossible to go to the road commission and to have enough time once that is done to come back. So it has been submitted to the state. Steve will do his presentation and hopefully he'll answer any questions that you have. I also submitted our 2014 CAFR to the Government Finance Officers Association for their certificate program, and hopefully we're successful in that review as well. But without any more comment from me, I will let Steve take over from here. And thank you, Steve. Is the email and the phone valid?
Today it is. It is, it's just somebody else's.
Yeah.
Dean's number.
Better not be.
Thanks, Steve.
We already have Dean's number.
Yeah, I'm sure you do. Home, cell,
We know where to find
tractor,
you.
whatever you've got.
Thank you.
I gave you the business card so you can find me if you ever have questions outside of this meeting. Some of you know how to find me already. And the other piece of paper that I gave you this is kind of a little roadmap to the financial statement. Okay, so we're gonna, just so you know, when you look at the financial statements for the county, under governmental type funds, those are the funds and the activities of the county that are included. You look at business-type activities, those are the areas that are included. Agency funds, you're going to see a separate balance sheet for the agency funds, and then component units are different areas of the county that fall under that particular caption. Okay, so without any further ado, I'll walk into the financial statement so you can see what I'm talking about here. We're going to start with the bound document, the big 240-page document that you have in front of you there.
I'm okay.
And just so everybody knows, not everybody completes a CAFR. What Dean was talking about, a comprehensive annual financial report, not everybody does that. That is a number of governments that do that, but it is not, we don't, most of our counties and cities do not do that. It is a level of financial reporting achievement that is reserved for the finest financial reports, and the fact that Dean has been able to get the certification year after year shows a lot about what the integrity is in the financial data that's included in the report. And as you can imagine, with a 200 and some odd page document, there's a lot of blood, sweat, and tears that go into that. And we at Raymond could not fulfill our responsibility without Dean and his staff that have been bent over backwards for us to help us, along with the Road Commission and other folks that we deal with at the pavilions. There's a lot of effort that goes into this document. So I knew that if I didn't say it at the beginning, I might forget. So thank you, Mr. Bott, and all the efforts that you put into that, and the pavilions and the Road Commission folks as well. Looking at the letter that Dean has prepared, I believe it's page 3, it's on the county letterhead. While this is a financial report, there's a lot of good information in that letter that talks about non-financial stuff that the county has pulled off this last year and over the last few years. So I would certainly encourage the board to spend some time reading that particular letter. I've read it at length a number of times, and it still amazes me how much we can pull off in our tiny little community with the resources that we have, and hats off to the county. And
If I could interrupt for just a
Sure.
second. John Syke, is John here?
No, he's
John assists with a lot of the information in that document. I don't want to take credit for that, but I ask John every year to help highlight a lot of the things that we're doing in terms of just the good things, the economic development. We talk about the film festival, just the wine industry, just to make it really, appropriate, or, just to give it a personal touch, because we do have a very special area that we live in, and we like to include that in the, in that document, so.
So there's some ancillary information in the report that auditors don't typically opine upon. After you see Dean's letter, you'll see an organizational chart. That is not an audited document. Next is the Certificate of Achievement for 2013's report. And then we get into the stuff that Raymond has responsibility for on page 15. And if I'm off on a page number, somebody tell me, because I'm using a PDF. So 15, is that your first page of the opinion?
Independent Auditor's
Yep.
Report.
Okay, yep, all right. So now I know the PDF is matching up with the bound copies. Okay. You'll see there, that's the Independent Auditor's Report. That is our responsibility to provide this report on the financial statements of the county. Briefly going through the document, the report on the financial statements, the bold caption there, basically tells you what we were engaged to provide our opinion on, which was Grand Traverse County and its affiliates through December 31st, 2014. So this is a 12/31/14 look back, if you will. We're 6 months out, obviously now, but this is as of 12/31/14. Under management's responsibility for the financial statements, these are management's financial statements. Our responsibility is to place our opinion on that based on our audit testing, and that's the consensus of that particular paragraph. Under independent auditor's responsibility, a lot of this language that you see here, you would have seen in the engagement letter when it was passed out back in December or January. Basically talks about what the auditor has responsibility to do in a financial statement audit. So if you look at the bottom of page 15, we believe that the audit evidence that we have obtained is sufficient and appropriate to provide a basis for our opinions. So we are comfortable with the documentation that we have received from the county in terms of issuing an opinion. Top of page 16. This is the opinion, and I will read that to you because that is the important part of this document. In our opinion, the financial statements referred to above present fairly in all material respects the respective financial position of the governmental activities, the business type activities, aggregate discretely presented component units, each major fund, and the aggregate remaining fund information of Grand Traverse County, Michigan as of December 31st, 2014, and the respective changes in financial position and, where applicable, cash flows thereof, and the respective budgetary comparison for the general fund and each major special revenue fund for the year that ended in conformity with accounting principles generally accepted in the U.S. That is a unmodified or clean opinion, and that's the highest level of assurance we as auditors can place on financial statements. So, it is a clean opinion. Under other matters, required supplementary information, there are documents attached to this particular CAFR, such as the management's discussion and analysis, the schedules of funding progress and employer contributions for the pension and other post-employment benefits are not audited documents. The MD&A is prepared by management. We read it to make sure it's consistent with the financial statements. However, we do not audit that document. Likewise, the tables of funding status on the different employee benefit plans are provided through actuaries, and we take those actuarial reports and put those into the financial statements without audit. So we are relying on the actuary for that. Last sentence in that paragraph, again, we do not express an opinion or provide any assurance on the information because of the limited procedures do not provide us with sufficient evidence to express an opinion or provide assurance. Under other information, there are a number of combining and individual fund schedules that appear after the footnotes. This report, or these two paragraphs, talk about our responsibility with respect to those financial statements and schedules. If you look at the last sentence at the bottom of page 16, in our opinion, the combining and individual fund financial statements and schedules are fairly stated in all material respects in relation to the financial statements taken as a whole. So our opinion does also cover the number of schedules that appear after the footnotes. There is a section after those schedules that's called statistical data. That information is not audited. That information is typically the required information to become a CAFR. So there's lots of non-financial information that's in there. There's some financial information, but it's predominantly non-financial. So, which is the next discussion at the top of page 17. That paragraph talks about our responsibility with respect to the introductory sections, and the statistical tables have not been audited. Other reports governed by the governmental auditing standards, you will see that there's an additional opinion at the end of the document, which we'll talk about. This just alerts the reader that there is another opinion in which to look at. Okay, so I'm going to move past through the MD&A. I'm going to move you all the way back to page... Page 33. Okay, the Governmental Accounting Standards Board, years ago under GASB 34 and 35, took all of the individual funds that you're probably used to seeing in your monthly reporting, and they created what is now called a statement of net position. So this is a consolidated financial statement of all your different funds, component units, and so forth. So I typically talk from this balance sheet because I believe it's the most inclusive. It has everything in one, it's a one-stop shopping balance sheet. We can talk about the other ones as we move through the document, but this, in my opinion, is the most useful document in the entire report. So you'll have two balance sheets and two income statements, as well as a reconciliation between the two as we work through the document.
Steve?
Yes.
What's the difference between the top of page 23 and page 33?
23 is the contents of the management's discussion and analysis. You're going to find a lot of very consistent information between the two.
Yeah, the numbers are pretty much the same.
Yep.
Yeah. Okay,
Yep.
Thank you.
So the formal statements that we issue our opinion on are the ones that begin on 33.
Okay. Hold off, yep.
So as the brief document I passed out to you talks about, you'll see the headings there: governmental activities, business type activities, total, and then the component units. The sheet I passed out has all the activities for the governmental column, which is the different funds that are listed in that document I handed out earlier. The business type activities are under the next one. There is a total, because that's considered the primary government, which is Grand Traverse County. Component units include items like DPW, Road Commission, Drainage Districts, Brownfield Development Authority, Land Bank Authority, and Hospital Finance Authorities. So there is a distinction with those particular items that puts those in the component unit section of the financial statement. So just be mindful as we're going through this document, that's kind of the roadmap as to what's included in each one.
Steve?
Yes.
I'm going to have a lot of questions about this page.
Okay.
But I think I'll wait until the end of your
That's fine.
discussion.
Yep, that's
Okay.
fine. Okay, I work from the total column. Total assets for the county, $119,541,000, consisting primarily of capital assets being depreciated, as well as those that are not. Receivables of about $23 million, and cash equivalents of about $23 million as well.
So the assets went down because of depreciation.
Capital assets, yes, they go down annually in the depreciation. If you add more assets, that could go up, but if you remain status quo, they will end up working themselves down. And there's a whole table that we'll talk about that in just a moment. Total liabilities, which is a bold caption there, total $25,743,000, consisting primarily of your long-term debt obligations and then your normal accounts payable and accrued expenses. Net position, which is assets minus liabilities, it's composed of a number of different items. You'll see $52,400,000 is invested in capital assets, so that's bricks and mortar and equipment and so forth. And then you have restricted for non-expendable trusts, revenue sharing reserve, state mandated programs, and you subtract all that and you end up with a unrestricted net position of the county at $30,038,390 under current reporting standards. So reporting standards are going to change, and we're going to talk about that, I think, when I get done. But that's where you are as of December 30, 2014, under the current accounting standards as written today. It's going to change dramatically as you roll forward.
Can I ask one last?
You can ask all the questions you'd like.
The business-type activities include things like the Grand Traverse Pavilions.
That's correct.
So when I look at the assets under that, obviously that includes the brick and mortar of the pavilions
That's
and
correct.
its internal things. As far as the liabilities, as you mentioned, obviously we don't have an actual picture of our liabilities now because of current accounting standards. So when we add in, and I received the draft copy, putting in our pension obligation and
Yep.
all of that, under business-type activities for liabilities, that factors in the pension obligation and retiree healthcare debt for things like the pavilions under business-type activities. Am I
Yeah,
correct?
that is correct. Not this document, not the formal.
Not this document,
right.
I understand
But the
that,
other
but
document that
starting
you may have
next year.
seen, that is correct. We're going to talk about that document.
But when
too.
I see on your list that you gave us, I see agency funds and component units.
Mhm.
Component units includes the Grand Traverse County Road Commission.
Correct.
Which also carries a significant pension obligation and retiree health debt. And those kind of things aren't seen on this at all. So neither the assets nor the long-term or unfunded liabilities.
They're here.
Right, it's not on this
Not
at
in the
all.
book.
Not the
So,
pension liabilities. The
next
assets are
year-
certainly there.
No, I know. But next year, when things change, will we see the component units change as well?
Absolutely.
Okay.
Everybody
That's what I
reports the
wasn't
same.
certain about as I looked up the GASB 68, because I know that there was concern of long-term debt with the road commission.
Yep,
And I wasn't quite sure where it fit in to this.
yep.
So
They will all
thank-
be adjusted accordingly. 68 will be adopted countywide.
And that
And
includes
15.
the agency and component units?
That is correct.
Okay.
And we're going to talk about those obligations because I've got some more information to pass out when we get to that point.
And by the way, I wanted to acknowledge that Tony is here.
Yes.
From MERS, in case you haven't met him or, but thank you, that's all.
Thanks for being here, Tony.
So that is the balance sheet as of December 31st, 14, under the current accounting standards. And again, we're going to talk more when I'm finished with where it's going to go. The next page is page 34, which is your income statement. And anybody who's seen an income statement would say it looks a little weird, and it does, because it's government reporting.
It's another thing.
I'll direct your attention to kind of the salient points. If you look at the expense column, you'll see all the governmental activities, legislative, judicial, public safety, economic development, et cetera. You'll see the business type activities as far as inspections, medical care facility, solid waste. The $81,696,694 is the total expended by the government, the primary government being Grand Traverse County. And then as you work across the document, you've got program revenues such as charges for service of $37.6 million, that's a revenue item, as well as operating grants and contributions, and then capital grants and contributions. Far right column has a $30 million bracketed number, which is the amount of revenues that were, expenses that exceeded the revenue prior to the application of property taxes. So if you go down to the next page, that $30 million bracketed number carries over, and then you apply general revenues. Property taxes of $28.7 million, unrestricted investment earnings of $163, a gain on the sale of a capital asset of $30,000, total overall general revenues and transfers of $28.9 million applies then against that $30 million reduction, gets you an overall change in net position of $1,388,000. That would be akin to a loss on a financial statement. So that's revenues not sufficient enough to cover expenditures by $1,388,000. Okay?
So did I understand what you just said? Revenues are below expenditures by $1,388,000?
Correct.
Okay.
For fiscal, or for year ending December 31st, 14.
Thank you.
Page 36 and 37 is a breakout of the governmental funds with respect to the ones that are in the column, governmental activities. You'll see there the predominant fund is your general fund, Commission on Aging, CDBG, Health Department, Lafreniere DPW building, and then all the little non-majors that appear in a schedule after the footnotes. And those would be primarily many different special revenue funds, many different debt service funds, and many different capital projects funds, as well as internal service funds. So those numbers on the page of 37 that total over to the right, those are going to roll up to the financial statement that we just went through, but this provides more detail as to what those components are. Okay? So when you look at page 38, there's a reconciliation between the statement of net position and fund balance, if you will, net position. The fund balances start out at $14,103,000 and then end at $48.7 million. And you'll see the big items that reconcile between the two are capital assets, long-term debt, loans receivable, et cetera. Those are the items that are in there. Once we know we get these two statements reconciled, then we are at a point now where we can finalize the document. You move to page 40. This is a statement of revenues, expenditures, and changes in fund balances. This is going to be akin to an income statement under under current accounting standards. You'll see the same column headings: General, Commission on Aging, CDBG, Health Department, Lafreniere DPW, and then all the non-majors are consolidated into that column. And again, these will roll over into the financial statements that we talked about earlier. Again, more detail behind the facing balance sheet that we've already covered. And on page 42, this is the reconciliation of the two different income statements with different items such as depreciation. That's the biggest number on there. Construction of capital assets, change in post-employment benefit obligations, amortization of bond discounts, et cetera, payments on principal obligations of debt. Again, you got two separate balance sheets, two separate income statements, and they are reconciled with these two lengthy reconciliations that appear in the document. So, beginning on page 43 is your general fund budget to actual expenditures. I would presume that you have seen this ongoing, as I know that Dean reports budget activity every month as he talks to this committee. At the bottom of page 44, you started out with an initial budget of $34.9 million of revenue. You ended up with $35.2 million. I'm sorry, you amended your budget to $35.2 million, and you actually brought in $35.5. On the next page, on 45, begins the detailed discussion of the expenditures. And the point to note here is that the far right should always be in brackets. If they are not in brackets, it is a requirement of our firm and of the accounting standards and state law to tell the Treasury if you have overexpended in a budget area. And you only had one this year, which is good. I just did one a week or so ago that had about 20 of them, and I'm sure that the state is going to inquire about those budget overages with that particular unit. The only item that appeared over budget was on page 46. It's under Health and Welfare Substance Abuse Program. $594,000 was the amended budget, and the actual amount expended was $864,000, a budget overage of $269,719. And we'll talk about more about where that's reported.
Should we talk about why that number's there?
Why it's
When,
there.
when NIMSAS reformed themselves, we had to pay retirement benefits to their employees. That's where that number comes from.
Well,
You remember that discussion?
Yes, we had a spirited discussion.
We had a
and the-
spirited
and the board
discussion,
was
sent
not,
multiple letters to them.
yes.
But the fact was, we ended up paying retirement benefits to their employees over and above the $685,000 that we, whatever it was that we paid to them.
It shouldn't have
And
happened, but we could do nothing about it.
There was nothing we could do about it. The fact was, their board voted to, with their restructuring, to pay out retirement benefits to their employees, and we had to pay the bill.
Yep.
That's why that number is off.
If the state sends a letter to Dean, that's a
They
totally
have.
appropriate answer.
They have.
They have.
Yep, there you have it.
Dean probably has a better explanation than my memory is, but I'm sure that's what it is.
Well, on the other side, we also received additional revenue. They don't
Right.
comment on the positive, and
Right.
it's a requirement of state law. You can't spend over the amount that this board sets in your appropriation. It's a valid point, and I will respond to the, I wish I could budget to the penny, but it's simply not possible. It's common to have at least one or two. Sorry for the entity that has several, but I think, if we could budget exactly, but you can't.
So when you look at the budget to actuals, those are the points that I want to make with respect to the activity. You guys have already approved your budget. You've seen it monthly. If you want me to go into a lot of detail, I certainly can, but this should be information you already know, except when you're over the budget, there is a report that I'll get back to that footnote in a moment, but I don't think it's going to be a big deal. Dean will send a letter to the state, and this will be completed.
I had a question.
Yes.
So the combination of the fact that we took in less than we had anticipated and that overage is what gives us a loss. That number that you said was on any other financial statement is the loss.
Yes. That is on the
That's-
statement of activities, back on page,
It was on 35, that 1.3 million?
you go to page, yes, 35, $1,388,000. Now remember, there are two different bases of accounting.
Right.
So when you're looking at the page 35, you're looking as the report of GASB 34, which is the combined
Gotcha.
everything.
Okay.
So when you go back to these other funds, you're going to see some different numbers, but because those are standalone funds, you have to aggregate all the funds to get where they are in the statement of net position,
Okay.
or the statement of
Right.
activities.
Got it, thank you.
All right, working through again on page 40, 45, and 46 of the general fund, you get into Commission on Aging on page 47. 48 is CDBG. 49 is Health Department. And then now we go into the proprietary funds, or these are enterprise-type funds. They look, act, and smell like a business, so that's why they're categorized differently than governmental funds. So you'll see here the assets, liabilities, and fund balance for the business-type activities, including the pavilions, the delinquent tax revolving, all the non-major enterprise funds, And then to the far right are internal service funds. That's where you would allocate a portion of your IT, your insurances, et cetera. But to point out here, total assets, that's under the total column for your enterprise funds, $52.9 million, consisting primarily of capital assets being depreciated and not being depreciated, receivables, and then cash equivalents.
What page is that, 52,000?
I'm on page 50.
Page 50?
Yep. It's under total assets, fourth column over to the right.
Okay, thank you.
Yep. Again, these all roll up into the balance sheets we've already spoken about, so this is just more detail that you have behind the nuts that are on the facing financial statements. Likewise, beginning on page 51, these are your income statements. Shows revenues, expenses, non-operating revenues, non-operating expenses for the different funds, for the pavilions, for the delinquent tax revolving, non-majors, over to a total. And if government reporting wasn't confusing enough, on page 52, the only funds that are required to have a statement of cash flows are the proprietary funds, because they look like a business. Otherwise, the governmental funds are not required to have a statement of cash flow. So these on page 52 and 53 are the statements of cash flows for those respective funds: Grand Traverse Pavilions, delinquent tax, non-major, enterprise, and total.
Steve,
Yes.
what does transfer in and transfer out mean?
Interfund transfers between one fund to the other fund.
Okay, thank you.
Mhm.
Does the new accounting standards require a statement of cash flows for government type funds?
Not that I've seen. They specifically excluded it from GASB 34, and you have to check with the GASB on that. I don't know why they excluded them. They're way more useful in a commercial type business, so that's why they're part of proprietary funds. I don't know how useful they would be on a governmental-wide basis. You could prepare them as ancillary schedules, but they would not be opined on by the audit firm. Okay. Page 54, these are your agency funds. An agency is going to be comprised of your trust and agency, your inmate trust account, district court trust, friend of the court trust, library fines, and water and sewer receiving funds. So you'll see they are comprised of cash and receivables due from other governments, as well as due to other governments, court items payable, undistributed receipts, and other liabilities. There is no fund balance or net position in agency funds, because those monies are due to somebody else. You're basically holding that money as an agent, comes in and goes out. On page 56, when you looked at the statement of net position on the far right-hand side, you saw the component units. This is the further detail of those component units, consisting of the Road Commission, DPW, Drain Commission, Brownfield Redevelopment, Land Bank, and your Hospital Finance Authority. Again, this is in more detail, and it rolls up to that combining financial statement. So any kind of detail you want with respect to those specific funds or operating entities can be found here on the balance sheet on 56 and 57. 58 and 59 are the income statements for those particular component units. Again, same column headings across the top: Road Commission, Department of Public Works, Drain Commission, Brownfield, Land Bank, and Hospital Authority. You'll see there where the revenues, expenditures, and so forth apply to those particular units of government. Okay, those are the basic required financial statements under the GASB 34. So those are the ones that we are required to issue an opinion on. If you wanted to start questions now, we've got a set of footnotes to go through first. I think you can find a lot of useful information in the footnotes. Maybe we should go through those first. So maybe some of your questions are answered when we go through the notes. Beginning on page 62. The county did not adopt any new accounting policies, nor did they change any accounting policies internally, so the footnotes are going to remain relatively consistent year over year. If there were the application of a new accounting standard, you would see that right up here towards the front. But this information should be somewhat familiar to those of you who have read the financial statements in the past. For example, page 62 talks about the reporting entity, the county, talks about your blended component units. It talks about your discretely presented component units. Blended means it goes into the financial statements akin to like a department. Discretely presented means it has a specific balance sheet and income statement activities solely for that particular component unit. And you'll see under the discretely presented component units which ones are in there. There's the Road Commission, DPW, Drain Commission, Brownfield, Land Bank, and the Hospital Authority. We'll round that out. County is also a party to regional joint operations, include the airport and community mental health, and those are disclosed in the middle of page 64. Under basis of presentation, this is the language that if you were to read this, you would get a better understanding or a more thorough understanding as to why governments have two balance sheets and two income statements and why. This is the language that was issued by the Governmental Accounting Standards Board. So this is going to give you the reasons as to why we have two of each. In the middle of page 67 begins the discussion about the accounting policies related to specific balance sheet captions. So for example, cash and cash equivalents in the middle, that shows your accounting policies related to cash and cash equivalents. Likewise with restricted cash, investments, receivables, and payables, go over to the next page. Inventories, prepaid items, and other assets, the top of the following page. Capital assets, the table at the bottom of page 69 is your estimated useful lives applied to those particular captions. Accounting policies with respect to deferred outsources or outflows of resources, unearned revenue, compensated absences, long-term obligations appear on 70. On page 71, you have deferred inflows, interfund transactions, fund balance, and it rounds out at the top of the following page, 72, with the use of estimates. Every financial statement has a certain level of estimation that's embedded in it, and that is the footnote disclosure that tells the reader that there are some elements of estimates in there, but we do not believe them to be materially off from the numbers that are reported. The budgetary process is briefly discussed in footnote number 2. Footnote number 3 is the footnote that the state of Michigan will look at and has already issued Dean a letter with respect to that budget overage under substance abuse. If you had a situation where there were no overages, you would not have footnote number 3. We'd go into footnote number 4. Deficit fund equity, the three funds that are reported as a deficit in the financial statements are discussed here, and the reasons as to why they are. Not uncommon for these particular funds to carry this kind of a deficit, but I don't know if the letter from the state addressed these to you yet, or Dean, or not.
They do. Two are building authority debt where we paid the debt off early. I will explain that to the state. That's not a problem, and we do have a deficit in our brownfield funds, but I will explain those deficits to the state, and we should be. I don't anticipate that that's going to be an issue. They've seen the deficits in those building authority funds before, and we actually ran that, what we were proposing by them, and they were fine with that. So the brownfield is a new item, though, this year, and I am working with Gene on that, so.
And the brownfield will eventually work itself out of that as it
Correct.
continues its activities. Yep. Top of page 73. Deposits and investments, this is where the cash for the county is. Where it's captioned on the balance sheet is under the total amount, so you'll see it's comprised of cash and cash equivalents, investments, and then restricted cash at the Road Commission. Investments are disclosed in the middle of page 74. Federal Home Loan Bank, Federal Farm Credit, State of Michigan GO bonds, money market accounts, and the like. Those are the composition of your investments. Page 75 discusses your receivables and payables in more detail, who they're due from, normal trade accounts receivable, due from other governments. There's an allowance for uncollectible accounts, loans receivable, taxes receivable, leases receivable, interest receivable, et cetera. And then accounts payable follows at the bottom of that table for normal accounts payable, accrued liabilities, claims, accrued interest, and then due to any other governments. I think we had a question earlier about capital assets, which the table on page 76 begins the discussion of capital assets. You will see where there are additions and disposals, any transfers that would have occurred to get to your ending balance. You'll see during the year there was $785,000 of additions to capital assets, and they had $2,037,000 of overall depreciation on those assets. The table on page 77 is going to be your business type activities. Again, these are the pavilions, delinquent tax revolving, foreclosure, et cetera. You'll see there they had put $313,000 of capital assets into service, and depreciation expense for those activities was $1.2 million. There are further disclosures on page 78 from the Road Commission. Those are tables that are taken directly out of the Road Commission financial statements. DPW appears at the top of page 79. Interfund receivables, payables, and transfers are disclosed in footnote number 8 on page 79. You'll see that anything due to from a fund also equates to a due to other funds, so those are in balance at $1,517,000. Further discussion on page 80 about the funds that have transferred to and from and where they went. That's in that bottom table on page 80. '81 begins your long-term debt discussion. That's on footnote number 9. This is going to show your beginning balance of obligations outstanding at the beginning of the year, any additions to those liabilities and reductions reported there in those columns, ending balance, and then the estimated amount due within 1 year. So that's what your debt service is for the upcoming year. Captioned again by primary government, under governmental activities, business type activities, and then you have the component units for DPW, Road Commission, and Brownfield. Page 82 is a listing of all your bonds outstanding. Again, categorized by governmental activities, enterprise fund bonds, DPW, Road Commission, and Brownfield redevelopment. Page 83 is a 5-year, actually, I'm sorry, it's more than that. This is a depiction of your debt service for the next 5 years in 1-year increments. And then beginning in 2020, they're put together in 5-year increments. So you've got 2015, you have $570,000 due on governmental activities plus the interest of $291. Business type of $1,235,000 plus interest of $237,000. And then component units of $3,350,000 with interest of $869,000.
Steve?
Yes.
When we start doing accounting for our unfunded retirement debt, will we see that figure on this page?
You will
Debt
see
service?
probably about 8 to 10 new pages of footnotes with respect to the pension stuff.
Right here?
Yep, it'll have its own separate footnote. It's going to have its own discussion about the unfunded liability and all of the assumptions that were made into it, projections going forth and going back. It's a very lengthy disclosure that will change next year.
Okay, but here, it would occur here though, right?
I doubt it. I think it's going to end up in a separate footnote. It'll be a separate caption on the balance sheet.
Gotcha.
So it's going to have its own separate distinction because of the dollar amounts involved.
Yeah.
It'll have its own line on the balance sheet with its own separate footnote to disclose the activities for that.
Okay, thank you.
Yep. Okay, continuing through on page 84, again, there's more principal payments that are due in the next 5 years and so forth. And then there's a lengthy discussion on defeased debt, which is bonds that have been refinanced or paid off. And 85, the discussion of what's been going on with defeased debt for your discretely presented component units. Conclude page 85 and roll over to the top of page 86. Footnote number 10 discusses Risk management, general liability, and so forth. We look for liabilities that exist. We confirm with the attorneys for the county to make sure there's nothing out there that would need to be accrued. So we're comfortable with the financial statements as they exist now, that there's no giant litigation out there that would require to be accrued. Moving through the document on page 87, general insurance claim liability, you'll see the tables there of what has transpired for 2014 and 2013. Claim liability at the beginning of 14 was $135,000. You had $2,500 in claims incurred and paid claims of $108.26, resulting liability of $30,147. Likewise, at the top of page 88, this is your workers' comp claim. Starting in 14, you had $39,583 of comp claims outstanding. $43,679 came in during the year, and you paid or adjudicated $18,161 to getting a claims liability of $65,101 at year end. Joint agreements are disclosed in footnote number 11, primarily the City of Traverse City and Grand Traverse County under the agreement to operate the governmental center. Policies on how you allocate or how you levy your property taxes are in footnote number 12. And then on page 89, under footnote number 13, starts the discussion of defined pension plans. I know this is going to be a topic we want to talk about, so what I'd like to do is just get through the financial statements and then go into some more detail about this if we could. The first item that talks about here on 13 is the MERS plan for the county. Okay? You go to the next page, page 90. The actuarial determined contribution it's been determined by MERS actuary. You'll see for 12, 13, and 14, the county has paid 100% of what was required. So you have no worry that you're not hitting the minimum, but you have hit the minimum and are in good standing as far as we're concerned with hitting those numbers. The middle of page 90, we start talking about the pension plan for the pavilions. Middle of page 91 discusses their required pension costs for 12, 13, and 14, and they also have hit the mark by contributing the actuarially determined amount on an annual basis. Road Commission appears on page 92, and once again, you'll see they had annual pension costs of $306, $386, and $484, and they met all those obligations as well. On page 93, footnote number 14 goes into some other defined contribution plans. The county now sponsors the Grand Traverse County Defined Contribution Plan, which is available for employees. This is not a defined benefit plan. MERS is a defined benefit plan. This is a defined contribution plan. The difference being that when you leave and retire under a defined benefit plan, the pension pays you for your years of service, your multiple, and so forth, until you pass away. A defined contribution plan is when you retire, you can take it, just like it's a 401k plan, and move away. The county would have no further responsibility for that retirement. Okay? Big distinction between those two, defined benefit and defined contribution. On page 93 also concludes with the discussion of the Road Commission's defined contribution plan. Page 94, footnote 15 discusses your other post-employment benefits. These are primarily related to health insurance for retirees. Now you're going to find a table at the bottom of page 94 that says annual required contribution of $476. There's interest being charged on the net OPEB obligation. There were adjustments to that obligation based on actuarial assumptions, et cetera. And the contributions made were $72,016. So what you've had is you did not fund that enough. So you take the increase of $404 and you add that to the OPEB obligation at the beginning of the year of $1,600,000. This goes up to $2,047,000. So this, in a nutshell, is the actuary said you were supposed to pay X, and you paid X minus some numbers. So if you do that, that becomes a liability on the balance sheet, and that's not new. That's been here, that's been around for years. So that is the number on the balance sheet that says post-employment, net other post-employment benefit obligation of $2.7 million. Yes.
Go ahead, you first.
Steve, I went back through some of the old audit books, which are spread out on my living room floor right now. And as you know, I know where to find you.
You do?
One of the things, I want to skip ahead to page 105, if I may. One of the things that I noticed was under the OPEB, the Retiree Health Care Plan, the actuarial valuation date, the last one is 12/31/2012. What happened to 13 and 14?
In most cases, you're not going to have an annual actuarial study done on those types of plans. MERS will have one done every year. Some clients elect to have this done every 2 or 3 years. If you ignore doing that, we would have a problem with that. But if it's done every couple of years, 2 or 3 years, we're comfortable with that.
Okay, so basically, every other year, we take a look and see that we're losing about, if you go back, I think we're losing about if you go back, 6 years, we're losing about $600,000 a year?
No, yes. Yes,
In
we
terms
are.
of the unfunded portion?
The unfunded OPEBs, yeah.
Yes.
And so, and they don't care? No one cares?
Well, I think more important, if you're going to look at 105, I think what's more important, you can see the middle column which says unfunded AAL, which is the liability that exists under this plan
Yeah,
as of December 31st, 12.
yeah.
The county has had a pay-as-you-go process in terms of paying these benefits, which you're not funding it. You're not funding the obligation, because in the second column, there are no assets to value for the plan. So you're paying as you go. And when the actuaries go and look at this, they say, well, there's no assets to pay for liabilities that have accrued, so that liability is going to continue to go up until there are some funded assets. Yes.
Go ahead.
What this basically means is that we're going into debt $600,000 a year, every year,
Just on OPEBs.
on OPEB only.
Yeah.
I mean, just
Well,
on,
it's just that one.
Yeah.
I mean, you're looking at that one. That one's just for the primary government. If you look, you were underfunded 3.8 million in 6, 4.8 million in 8, 6.1 in 10, and 7.3 in 12. So yes, it
every
is
year it's
going
going
up.
up, we're at least $600,000.
At least.
Now, what bothers me about that is that this is a real debt that we're going to have to pay. Every 2 years, it's $1.2 million. I've never known that until now.
Well, it wasn't even mentioned in the audit books. I couldn't find anything until I looked, the first time I saw it was in a footnote in 2006.
Yep.
So prior boards, it wasn't even in the audit books.
That's the point I want to make to this board, is that this is an important thing. This is a $600,000 a year. We go more into debt year after year after year after year. It's not being addressed. I think that a debt like that should be talked about every month. So I just want to point that out, that I think it's astounding.
What is our number for 2014 on the, it leaves us at 2012 with a debt of $7.3 million.
We don't know.
Well,
According to this
$9 million
chart,
now.
we're going up quite a bit more than $600,000 a year in debt.
Well, I just averaged it like over 6 years.
If you average it out, it says $7 million now, but if you use,
In
if you project it
2012.
to 14, it's going to be 9.
My assumption would be based on the percentage that it's going up, that we are roughly about 9 million in debt.
Yeah, that's what
on
I'm
that.
figuring too.
I guess where I'm really confused by this, we looked at the charts and we saw we were making 100% of the minimum required payments for MERS for 12, 13, and 14. We get to this chart on 95. We, in 2012, paid 16.3% to
You
OPEB.
got to separate. There's 6 plans.
Okay.
There's 3 MERS plans, one for the county, one for the road commission, and one for the
Yes.
pavilion.
And I just want to address the counties primarily right
Okay.
now.
Yeah.
But
Just me.
Just so there's 6 different plans. So the
Right.
MERS plans are all being funded according to what the MERS requirement is.
Right.
If you don't do that, they're going to tell the state, and then you're going to have a whole different set of issues. The OPEBs have not been funded, and the OPEBs are totally different.
I understand.
So when you see these numbers being unfunded or underfunded, it is the option of the county to operate as a pay-as-you-go. But that liability will continue to build and build and build and build.
Sounds more like don't pay as you go.
So we chose to only pay, for instance, in fiscal year 14, 15.1% of what we could have paid.
That is correct.
Okay. So I guess I'm really confused. In the real world, what bill you can choose to pay? I would like to pay 15% of my mortgage every year, but they tend to frown upon that.
That would not be looked upon very well.
Is there oversight on the retiree health care plan? I mean, we have retirees that are relying on this health care in their retirement. Many of them need it. And it is being funded to the tune of 15 to 16%. I guess I'm a little, we only pay the MERS because apparently it's required or we're going to get a slap on the wrist.
Right.
Is
We
there
get
no
it-
slap on the wrist for the,
If we don't pay our MERS, we get an emergency manager.
well, if you don't pay your retiree health care, which to me is pretty important to the retirees, and it was a promise made to them,
Correct.
at some point, something's got to give.
That's correct.
Okay.
With respect to the OPEBs, those are typically benefits that are committed to by a municipal unit of government outside of pension. So some are collectively bargained, some are not. Some may choose to modify these, some may not, some may fund them. It's totally up to the board as to what you would like to do with these OPEBs. When you look back at old accounting financial statements, you'll see there was no mention of OPEBs and MERS and so forth.
Nothing.
They started in '06 with reporting in the footnotes what the unfunded obligation was. The next step now is GASB 68 that says they're going on your books, because they don't believe that, the liability existed back in 1984. These liabilities have always been there, but now it's the GASB's process of discussing it in a footnote and then getting it on the balance sheet. Yes,
Let's
sir.
go back to MERS for a second. You said we pay 100% of what they require us to pay, but yet when I get my little pocket calculator out and crunch the numbers over the last 25 years, we're going $1.9 million into debt more every year with MERS. So even though we pay 100%, it doesn't pay off the bill.
Steve, one of the pages that you called my attention to in the audit book was page 104. And it's the required supplemental information, MERS, agent, multiplier.
Yep.
Okay.
That would be the county's MERS plan.
And one of the things that you circled was the 915.7% on a page that
that's-
you
yep.
gave me.
Yep.
I did not have the 1,005.1% at that
Going
time.
up and up and up and up.
Which, would you expound a little bit on why this
Absolutely.
is a serious problem and
It-
not
it-
getting better?
It follows the old Social Security system. The more wage earners you have paying into Social Security, if you have 6 wage earners paying for 1 retiree, the system can work. So nowadays, you're at a system where it is 2, maybe 2.5 workers paying for each retiree, and that's causing the heartburn in the Social Security Administration in terms of meeting those benefit obligations. So what this is attempting to tell you is that your unfunded portion of your liability and covered payroll, so covered payroll, $4.6 million in 2014, it would take 10 workers to pay, 10 to 1, to pay this $45.8 million obligation off the unfunded liability. You don't have enough workers that are pushing into the plan to make it so it's successful for those that are out.
Yes, Dean?
But I do have to comment, we've closed our divisions. I
That
mean,
is
that
correct.
covered, this statistic is totally inflated in terms of most of the employees, most of your covered payroll are on employees now that are on the defined contribution plan. It's a statistic that when prior to 2001, if everybody, if we had all of our employees on defined benefit, it would make more sense than it
correct.
does now. So,
Dean is absolutely correct that covered payroll, as you take people off these plans, is going to go down. And your liability is going this way, so that number is going to follow.
and ultimately, at some point in time, when your last employee retires from, and we still have 2 open divisions, which we're working on, when your last employee retires, if we have an unfunded liability, I mean, how do you calculate that percentage? You would have no covered payroll. So just keep that in mind when we look at that statistic. Is just, you know, it scares you, but it's not really telling you much, in my opinion.
Well, can we just finish up the footnotes and we'll come back and talk about pensions? Because
Yeah.
I see a spirited discussion as we roll along here, so.
And I'd like to leave.
I'd like to leave.
I won't. I'm kidding.
We all have to stay here, Dean.
I will.
Dean's late for dinner.
No.
Okay, so I left off on
Except for Bob.
95.
On 95, which is the discussion of the county's OPEB, we talked about that table. You're going to find in the next 2 pages, the same, at the bottom of page 6, is going to be the OPEB obligation for Grand Traverse Pavilions. Again, 14.8, 14.3%.
I don't understand that.
And then Road Commission will appear on page 98. You can see they bumped up their funding in 2014 from 26 to 87%. And then at the top of page 99, there are some actuarial assumptions that are used in the development of the OPEB liability that are discussed at the conclusion of footnote number 15. Footnote number 9, page 99, commitments and contingencies. This is basically a catch-all. Talks about lawsuits. It talks about participation in federal and state grant programs, the results of periodic audits by the state or by the federal government. We've looked at all of that stuff, and we do not believe there's any exposure to the county at this point with those particular activities, at least nothing material to the financial statements. On page 100 is a very brief discussion of the related party transactions to the foundation for the pavilions. 101 is page 101, footnote number 18. Excuse me. Is a very lengthy spreadsheet that talks about your allocation of fund balances between the different entities and the different funds.
The very bottom is the year-end balance in the fund balance for
That is
those the entities that are listed on there,
Those
right?
particular funds, that is correct.
Okay. So our year-end fund balance was 8.9. That means any money that would have been used from the general fund was already out of that. So anything that covered 2014 costs,
It's all out of
the
that.
remainder is, okay.
Yes, that's correct. And then to conclude with the adoption of GASB 54 on page 102, the new footnote that talks about your net investment in capital assets, basically shows you capital assets in the first subtotal, and then it shows related bonds payable outstanding for a net investment in capital assets for the governmental activities of 35 million, business type of 18 million, and then component units of 75. So that would conclude my presentation on the 14 financial statements. And like I said, the documents that appear after this are going to be those consolidating schedules. There's a ton of minutia in there. I'm happy to talk about whatever you'd like to talk about, but there's got to be 75 pages of those, and I'm sensing that if we go through that, you guys might be asleep. But I'm more than happy to go through it. And then the statistical section after those schedules would be the statistical info that goes for the comprehensive annual financial report.
Steve, I was flipping through here, and I didn't see the page. You showed me a page in your office where we listed the changes. You listed the changes in our benefit plans, which affected, and it still to this day affects our unfunded pension liability.
Correct.
What page is that?
That is not in your financial statements.
That's
in the
why I
MERS.
can't find
That's in
it.
the MERS annual actuarial report.
Okay.
So, and Tony can speak
All
to
right.
that when it comes time. So I if we want to put this piece away, we'll answer any questions, obviously, if there are any questions about the financial statements. But, well, are there any questions on the financial?
I have questions on this.
Right, and that's what I'm going to bring out, I'm going to pass this out.
Yes.
And
And I think Tony'd probably like
I'd
to
like to,
leave, too.
Tony wants to leave.
we're ending the audit. It gets a top A+ grade due to Dean and his staff.
Absolutely.
And thank you, Dean.
Yep.
We want to talk about the future.
Yep,
Okay, so are you ready to do that?
yes, I am. Can I
Okay.
pass out some pages real quick?
Okay.
These are a little prettier than the ones in this, interesting, just with some.
I'm more than happy to look at a prettier picture than what I've seen. All righty. All right.
This is the same thing I emailed to all of you.
Yeah.
Yeah, these are, they've got, instead of handwriting exhibits on the top, I typed it in there.
Oh, this is the same thing, yeah, same numbers.
Yeah.
Draft on it.
Okay.
So if you look, let's start with exhibit number 1. And exhibit number 1 is the document that talks about what your financial statement would look like if GASB 68 were adopted for December 14. Okay? It's not required to be adopted until 15, but if you look at that document, the changes in the financial statements are highlighted in yellow. If you put the net pension obligation for the governmental activities for the county, your $45.8 million obligation that hits the books. For your business-type activities, pavilions to be specific, $5.8 million. For a $51.7 million obligation that is going to hit the books, presuming that this happened as of 14, all right? The direct reduction of this liability being put on the books affects your net position, unrestricted net position. So where we started out with, get back to it here.
What page in the?
33.
Big book, thank you. Does this correspond with, thank you.
Yes, it should be,
It's
it look
33.
exactly the same as 33.
We go from up 48,681,000 down to 2,867,000.
No, we actually go to a negative 4 million.
That's when you add OPEBs in.
Okay,
This is just, but still.
okay.
I haven't figured out how to make an iPad go any faster than this. I know there's a way, but I don't have.
And
All right.
road commission is not on this as well.
Road commission will be on the far right.
Unit.
Part of
Yeah.
component units.
Yes.
Yep.
So that's their pension in there. Because
This
there
is just-
isn't really
this is just
anybody
the
else. There's
pension.
road commission and pavilions.
At DPW,
Right.
and, yeah, and pavilions, but pavilions is under business-type activities.
Right, okay.
So when you look at that, the only place that you can charge when you book that liability is it comes out of unrestricted net position. So you start the year out on, if you look at the financial statements on page 33, unrestricted net position was $7.9 million reported in the audit report. Had 68 been adopted in 14, you would have gone into a $37.9 million deficit. Likewise, on the business-type activities, it had gone from a $22.1 million to a $16.2 million number. Totals are just the math of that, and then the component unit would be the road commission.
So basically, when you're doing it the old way, the way that this one is done, we reported a net position of about 48 million plus change. And the new way, our net position would be,
2.8.
well,
Negative.
Well, actually, negative 4.4 if you add in
negative,
OPEBs.
yeah. So we're looking at a $53 million difference.
Correct. Which is that number, the first highlighted line, it's going to be the net pension obligation number. It's a direct correlation. You put the book of the liability on there, it comes right out of fund balance.
And this is a real debt, isn't it? We have to pay it.
This is an obligation that the county has committed to, yes.
Okay.
Yep. And so GASB 68 is required for adoption next year. The OPEBs do not follow GASB 68. They are going to have their own pronouncement that's due 2 or 3 years later. The document is in an exposure draft position right now. And I would expect that to be around maybe an 18 or 19.
We'll make a point. I think this board should be the board that makes a difference. We should not just meet what the government requires. For instance, just because OPEB isn't required to be reported, we need to address it, just like we address all this other stuff.
If we were to choose to add that on, just to help my very rudimentary mind here, where does OPEB fit in? Is it government activities?
If you look at exhibit number 2 that I've also passed out, that factors in the OPEB liabilities. So you'll see under net pension obligation.
Oh, I see, obligations under
Yep.
other post-employment. So
Correct.
that does factor into government activities for our employees.
Yep.
The pavilion employees under business type, road commission under component.
Correct.
So when you factor all of that in, if we were to close up shop today and sell everything we own at the county, we still would be short $4.5 million to pay off everything we own.
That's about it.
Well, no.
I need to understand.
It's part,
That's
you're
a lot of
partially
numbers
correct,
here.
because you got to remember, on the asset sides of the balance sheet, those are booked at historical cost less accumulated depreciation.
Okay.
So this
Not
building
what
might be on the
they
books for $1 million.
Historic court building, courthouse has a value of 0.
Right.
Gotcha.
So if you sold that real estate and you brought the funds in, obviously you would have way more than 0.
Understood. Okay.
So when you look at fair value of assets versus the historical cost that is the requirement to report under, you would have, I mean, I can't say for sure because I haven't seen any appraisals, but fair value, if you sold assets, I don't know what that would do to that liability. It might cover it, it might not.
Okay.
So,
But realistically, we're not selling the courthouse.
No.
I mean, realistically.
But as far as how this
realistically,
is
we owe-
reported, if we were to not accumulate any assets for, say, 50 years, eventually we would have it to 0
Correct.
under total assets. But it's not because what we owned was worth 0, it's just factoring in the depreciation of it.
That is
Okay.
correct.
It is a different way than I do balance sheets for my business, so I'm just trying to.
quite all right.
Ours is if something went terrible and we all had to sell it real quick, can we pay off, what we owe?
Right.
So I'm just trying to understand that versus government and fund accounting, which has certainly been a crash course
It's
in
a
6 months for me. so.
baptism by execution for sure, if you're not familiar with it.
Steve,
Yes.
you met with 3 of our board members to look at your company doing a financial analysis. Can you give us an idea of how you're going to handle that?
I was given very specific instructions, what's today, Wednesday?
Yesterday.
Yesterday.
Yep, the days all roll together. We are going to prepare a June 30, 15 statement of net position, so you'll see where you're at as of June 30, this document here as of June 30. And then we are going to prepare a 3-year, beginning in 16, 17, and 18, budget, and see where projected, obviously we have to use some assumptions in there, working with the finance department, and validating to see what it looks like out to 19, okay? Along with that, we are going to come up with some recommendations or some ideas that the board can consider in terms of trying to get this obligation funded.
Will you include MERS in that and OPEB?
Oh, yeah.
And how about the dams?
Steve-
And also the dam.
The
Well,
dams.
so that's the other point to look at. On that exhibit number 2, you see that other committed liabilities has no numbers in it. Okay, that's where you're going to find anything else that we unearth
I
that
see.
is commitments beyond December 31st, 14.
In your analysis, will you include that?
Absolutely. Yeah.
Okay, and the other question I have, and I'm not pressing you,
That's okay.
how soon can you get it done?
I will begin working on this thing as soon as I get done tonight. So
Will
it's
you
gonna,
have it in a month from now?
it's gonna take, I would think a month is gonna be too quick. I'd say
Can you
2 months.
report to us on what you do know in a month?
Absolutely. Yep.
Okay, let's make sure we do that.
And what I wanted is I want to meet with the same commissioners I met with again and make sure that what I'm getting at is what they want to see.
Yeah.
And then once it's done, as I told the commissioners earlier, we can provide that template to Dean and Finance, and that can be a working document rolling forward for 19 and 20 and 21, under certain assumptions that would need to be modified over time, but We've done that for a multitude of our clients, where we prepare these kinds of documents, populate them, review them, if you will, and then once everybody's comfortable with the format, then we can pass it off to the client to populate the numbers. That just keeps our fees down. And then we can do the.
So kind of a dashboard kind of a thing?
Exactly, almost like a dashboard.
I'd like to have a dashboard that we could look at this level once a month.
Correct, yep.
So,
I don't know how often MERS reports to you in terms of their, the net funding obligations. I know it's annually because we deal with them annually, but I don't know how often they are. Is it just annually? It's an annual number. So the number is going to, it's not going to move every month. It's going to move on an annual basis.
I want to go back to OPEBs for just a second.
Yep.
When John Roberts was here, Governor Snyder's budget director, one of the things he talked about that Governor Snyder addressed when he walked in the door, he found that the state of Michigan had not funded one single penny towards OPEBs. And at that particular point in time, he said, okay, we are promising these OPEBs, we're going to start paying for what we promise today. And we're going to pay a little extra to catch up what we haven't paid in the past. And John Roberts, the budget director, did show that the state of Michigan doing that has been making some progress on their OPEBs. I'm just tossing that out there because it just, I thought his presentation to the chamber members was excellent.
Well, and it's really no silver bullet. The answer is money.
Yeah.
Money needs to get into the plans.
Yeah, I
That's
asked Tony the
answer.
same thing. I said, well, what does this amount to? And he says, pay more.
Excuse me.
That's what he said, pay more.
Right. And,
oh, yeah, I'm sorry. Who?
Sonny.
Oh, I'm sorry, Sonny.
Yeah, I mean,
I was lost in outer space, I'm
that's
sorry.
okay. I guess the one thing that, and Steve and I talked about it with the committee yesterday, one of the things is when we talk about this balance sheet, if you will, it's not only important to talk about the liabilities, but we also need to get a realistic number on our assets. Because the net financial condition of the county isn't anything like what you're seeing on this form right now. Because, like we said, the value of the courthouse, the historic courthouse is zero. Because these are all historic costs less depreciation. Mm-hmm. In the past 20 years, we've built the pavilions, the cottages, the district court building, the airport, the law enforcement, we purchased the law enforcement center, we've purchased the public health the public services building, we built the health department. All of those are assets that the county has that we've acquired for the community, and yet we seem to talk solely about our liability.
I really appreciate that. I think you're exactly right. But I honestly have to ask myself the question, would we have done all that if we'd been paying our bills off right along? But we've had the money to do that. I mean, we've got $55 million here that we owe somebody. It looks like we essentially borrowed money from OPEBs and borrowed money from MERS and did these things.
Well,
I guess-
actually, we didn't. We passed a millage to pay for the pavilions. So that's a property
pavilions.
tax millage.
But you see my point. I mean,
But
if we...
it is a county facility, but that didn't come out of the general fund.
No, my point is that yes, we did a lot of good things, but while we were doing those things, we did not pay our bills.
Well,
You're right.
I'm not sure that you can necessarily say that we didn't pay your bills, and this is not an agenda item. The agenda item was to review the audit.
Okay,
The
you're
pension
right.
obligation and those kind of things is an ongoing discussion that I think we have to continue to have. I think somewhere along the way, at least in my mind, MERS has to take some responsibility here. They do an annual evaluation and tell us to pay this number of dollars. We have made that payment 100% of the time. We've made that payment. We had a 3-year freeze. I understand that, but they agreed with that. The point is, we have made the payment that they have asked us to make every single year. Why is our percentage of being funded continuing to decrease? If we're making the payment that they tell us we have to make to fulfill our obligation, why are we becoming less funded than we were 5 years ago?
Well, I think, I don't want to point fingers. I'd rather, as a team,
Tony can-
look forward. We've got this problem.
We've got a debt,
Let's,
let's
as a
figure out
team,
how to pay it.
Get out of it.
Absolutely,
Yeah.
and that's what we have to work to.
Yeah, we can do this. But like Carol said, we're looking for maybe a 15-year solution or something, and you'll be helping us with that, right?
A mix of different ways of handling this.
And there
Get
are
out
many.
from under it.
There are many different solutions that, between myself and Tony and what I see in other clients are doing, we'll bring those to you as a board to consider. The ultimate decision lies with you, obviously, but as far as being able to get this obligation funded, I have hopes that you guys can do all this. I don't think this is something that you're not going to get done. It's in the front of all of you now, and I think it's important. From the people I've spoken with, it's important. And your retirees, it's important. Your current workforce, it's important. So let's stick our nose in the books and get it done and figure out the way to fund this thing. And
We
get
can do it.
behind us.
If we're going to transition to a MERS discussion, I would like to ask Tony to take a peek in his crystal ball and kind of, well, I'm pretty sure that they have to redo their actuarials on a regular basis.
I wanted to ask
And,
about.
people are either living longer or they're not, and that all affects what we owe. And what do you see in your crystal ball? No, you'll need to go to the
Come up.
microphone, Tony.
I have also heard the explanation of why it keeps rising, and if you could fill us in on that, all of us, that would be helpful.
You're not leaving, are you, Steve?
Nope.
Okay.
Run away.
First of all, thank you for letting me be here tonight. The first question is, could you repeat it? It was like, I think it was,
I want you to
what have
look,
we done to keep up with the changes in the assumptions which actually
And what-
calculate your
and
annual
what are you
required
looking
contribution?
for down the road? Because, we had a few years where investments were not what we all hoped they would be, et cetera.
Our pension system does an experience study of the assumptions every 5 years. So there are many assumptions which we use to predict an unknown certain event called someone's retirement. We are trying to, during their working career, pre-fund that defined benefit retirement. So we don't know how many years they're going to work. We don't know how long they're going to live. We don't know how much money they're going to make. But we do put assumptions to try to value that. And then these assumptions, many of them, there are many of them, we evaluate them every 5 years. One of them would be the rate of return that we get on the dollars that you give us. Is our current 8% assumed rate of return still valid? Throughout the years, throughout our history, it has shown that, yes, we have achieved that. In this current 15-year period, 2000 to 2015, we have seen some very large losses. There's 4 years of losses during that 15-year period, or 14-year period. And you'll see that we're considering, does the experience study, we've done an experience study, it just ended for the years of 2009 through 2013. We're making suggestions to our board to see if they want to make changes. They're actually meeting this week.
When will we know?
I don't know when the board's going to make a decision. They may ask, the reason I don't know is because they may say, we would like additional information on the experience study. We hope that we'll have information in the near future. They may make decisions this week, and then we'll be able to start sending that out to our municipalities. They may ask for additional information, so it may take some time. But we have, our most recent experience study has been completed, and recommendations have been made to the board, and we'll see where they go. Things that we've considered were, this year were the investment return. Should it be changed? If it is lowered, that means required contributions by the employers go up. One of the things that we've looked at, as you mentioned, was life tables. Are people living longer?
Mm-hmm.
And we're going to go through that, and if they did live a little bit longer, we're going to have to change that assumption. So if people are living longer, receiving a benefit for a longer period of time, the liability is going to go up, so contributions are going to have to go up.
So would you say or estimate that maybe within the next 6 months, we would know
Oh,
something?
absolutely. We'll have answers about that.
Okay,
There may be a partial, say, this is what we've done, we've asked for an additional evaluation of 1 or 2 or 3 of those assumptions. But
Okay.
they'll tell us some of the changes they have made. One of the other ones is the amortization period of the unfunded accrued liability. How fast are we going to collect that unfunded accrued liability? We've made some changes, we may make changes in the future to that, but how we're going to ask that to be collected so that it's maybe more in line with while it's being earned versus being stretched out for long periods of time.
What-
So those are examples of changes that can be made through an experience study.
okay.
Now, will that information be available in the next 6 months?
That is, yes, that's still part of this experience study.
Anybody else? I want to make sure every commissioner's had their say and.
You know, I guess the comment that I would make is that, you know, the amortization schedule was supposedly at 30 years, and then they did, when we closed the defined benefit program, they did an accelerated amortization for 2 years for every single calendar year. We did freeze it for 3 years, I understand that. But the fact is, for basically the last 12 years, we've paid off 20 years worth of amortization in that 12-year period, or better. We have, about 14 years, I believe, left to where the projected payoff was.
Well, here's what can happen when, each year, when we do the annual evaluation, there could be a new unfunded accrued liability created by assumptions not being met. There could be a payoff of that unfunded accrued liability by assumptions doing better than we thought. So that's why we do the annual evaluation to keep in line the value of pensions earned at that point in time as we value all those assumptions and the demographic and financial data of the system. So at each point in time, there could be a change in that unfunded accrued liability or each annual evaluation.
Tony, are you familiar enough with our position in MERS to tell us about how much each year we're going into debt?
Well, what I've done, and this is where it gets to understanding how we fund the pension system. It's different than calculating the liability, but it's how we fund it. And we have adopted what is called a 10-year smooth rate of return. So every year, we only take 1/10 of the gain or loss. So from 2008, we have recognized 7/10 of the loss of 2008. 2009, we have recognized 6/10 of the gain, and so on. And when we do that, we calculate the actuarial value of assets, which are different than the market value of assets. And when you would look at your annual evaluation, we show both of those numbers in 2 different tables. But we calculate the required contribution that the county is to pay to fund those pensions based on the actuarial rate of return. So starting in 2008, when we took that 10-year smooth rate of return, your assets were overstated by 39%. And each year, they kept getting smaller. That overstatement was getting smaller. To currently, in the 2014 valuation, your assets are overstated by 6%. So market rate is here, actuarial value is here. Therefore, the question came up, I think, by Commissioner Crawford, of what is the difference that we're losing, or you asked too, what are we losing? And really, it is the difference between our actuarial rate of return and our recognized rate of return. The assumed rate of return is 8%. It's basically been about 6% during that period, from 2008 till now. And so I was able to show Commissioner Crawford a graph. I only have one copy of it. But it's a visual here that shows the red line is the 8% assumed rate of return. The blue line is actual rate of return. So that gap is what is not been earned. Mm-hmm. So therefore, we're saying pay this, assuming we're going to make that 8% return. This is what you pay, but we didn't make the 8% return, so that's the gap. That's where the loss is coming from. But if we had used a market rate of return in 2008 instead of being at that time 50-something% funded, you were probably 30, I got it here, but I think it was more like 35 or 36% funded. So we started to work in those losses 1/10 every year as we went through. So to say that you are now 48% funded, yes, that's still overstating your assets by 6%.
So we're really not 48%
If we would have started in 2008,
funded.
you would have been down
That's
in
not good news.
30% funded, working your way back up.
You know what, Tony, that still doesn't, I understand what you said, but that still doesn't answer my question. When I look at OPEB, I can see we're losing $600,000 a year. How much are we losing a year in MERS,
Well,
as it is now?
the question is how much are we asking you to, requiring you to contribute in?
No, that's not what I mean.
You haven't lost any money being with MERS other than in 2008. That was the last year we had a loss.
We have a debt,
Yes.
all right, and it's growing. How much is it growing a year?
The liabilities grow. It shows you here on this table.
Yeah, but if we have a table that shows that the liability continues to escalate up to like 2017, and then it starts to drop back off again. That's, what you're asking, if I understand it right, is how much are we growing each year until we get to that point? But then there's a point here, 2017, 2018, that liability drops off.
Not if we continue to, if he says that we're getting credit for 8% of growth in our assets, but we're actually only getting 6%.
So you're
Then
asking,
we're
what's
losing,
that
we're
2% represent?
losing ground. And Steve nodded when I said, we're losing ground.
Well, also, he also said that we have to put more in.
Well, that's really the bottom line.
There are some municipalities that are paying double what MERS are asking them to catch back up. And I guess I'm trying to get to that common sense number, you know,
How much
I crunched the
more
numbers, it looked like
should
$1.9 million
pay
a
every
year.
And so going to Commissioner Maxwell's question, how much more should you pay?
Every year.
And we put in into this annual evaluation, tables that would say that if we only did get a 6% return, your required contribution should be this. And we started doing that a few years back. And if we would go to that table there, and I reviewed this with Steve, you would see that on page 10 of the annual evaluation, your required monthly contribution would be $529,000 versus the $398,000.
And what have we been making?
You've been always making your payments.
We know we've made
Making
a payment.
payments based on 8%
8%.
growth,
Yeah.
but the growth has been
Well,
6%.
the truth is
So we're
that that is growing.
underfunding it by 2%.
So we're underfunding. We need to pay more.
And the purpose of that was to smooth out the required contributions for affordability
Right.
of the plan.
Yeah.
In the annual evaluation, it always states this is your minimum required contribution. If you have additional assets and would like to contribute more, we would accept those. But we can only ask and only mandate that you pay the minimum required contribution, and that's what we have done.
Okay.
This is like a credit card that you owe $30,000 on, and they give you a minimum payment, but it never gets paid off. It all, you know, we have to pay more into this system. I mean, this is common sense.
I have a question for Steve. Steve, you audit more than just Grand Traverse County. You work with other municipalities. Have you seen other municipalities stepping up the amount that they're paying?
Absolutely. Almost
And-
all of them have funded MERS more than their 100%. Some way more than, as much as double.
How many clients do you have that have MERS?
Almost all of our municipalities have MERS.
You have, what,
I serve probably 20.
of those clients, where do we fall in funding for MERS? In percentage? Are we in the bottom 1%? Where are we?
In the plan, as far as the MERS plan, or?
On unfunded liability?
Yeah.
Where are we?
And Tony, I think, can address that, because there's that You're not going to like the answer, but
I think he was asking among your 20 clients that you work with.
Yeah, your 20 clients.
you're very high. Your unfunded liability is very high.
We're
I
at the
serve a
bottom?
couple other municipalities that are different brands of governments.
Yeah.
That have bigger numbers, but they are not in the MERS system. They're in a different system. They're in a different public school system, so that's a little different. But as far as those that serve in MERS, your unfunded liability is, if it's not at the top, it's close.
So we're not in good shape, relative to your other clients.
Correct. And
Okay.
my answer is, which I stated a minute ago, is we have a problem. We need to fix the problem. The silver bullet is money.
Yep.
Other clients that saw GASB 68 coming down the pike decided to start putting more money in. If you read their annual report, a couple $100 million in 14, $173 million and change are overfunded over the requirements reported into MERS in the last 2 years. And
Okay.
they are doing that conscientiously to try to etch this number down.
In the MERS system, you know, of where do we fall? Are we in the bottom 10%, bottom 20%?
We have 712 municipalities that have defined benefit plans across the state. We have, there's a graph here, and I shared this with some of you, if not all of you, in the past. And this is based on the 2013 Consolidated Annual Report. There were 101 municipalities that were over 100% funded. But there are only 39 municipalities that are under 50, and that's where the county falls. The majority of, so you're, out of the 712, I believe, there's only 39 that are in 50% or less funded like this.
So
county
we
of
are
Grand Traverse.
in the bottom
4%.
bottom 5%.
Yeah.
And then when you were talking about paying additional dollars, we started tracking this in 2012. Statewide or MERS-wide, our municipalities put in $180 million additional funds. In 2013, $211 million, and then last year, $200 million. So collectively, as Steve said, many of these municipalities started putting more than minimum requirement to move their fund position up. And what that really does is make their system that much more efficient.
Yes, Dean?
Would you know how the dollar amount of those contributions that were pension bonds? Because is that all just general, or would some of that include pension?
In this report I have, it just says additional payments made into the plan towards
So
unfunded liability.
I could probably reasonably conclude that some of that would have been like Saginaw County and Ottawa County that did issue pension bonds and...
And we only had that happen in 2014. So what happened in 2012 and 2013 did not include bonding.
Okay. So people were paying more
Yes.
without bonding.
Okay. Yes.
I have a really general question for Dean, really, not to put you on the spot, but you are who has been here, so maybe you can help me as someone that wasn't. Why hasn't Grand Traverse County been paying more money? Do we just not have the money in our budget? Is it something that simple that we just simply don't have the money? It sounds to me as if hundreds and hundreds of municipalities have stepped up to pay more than the minimum requirement. I would assume it was a response to the 2009 crash. Seems reasonable. Everybody was sailing along at 14, 15%, and then all of a sudden, 09 comes along. But it's been over 5 years since the crash, and it sounds like other groups are stepping up. What would be our main holdback in Grand Traverse County? What's the biggest challenge we face in order to make a more than minimum payment?
Well, I think, in all honesty, it's the budget. You know, it has to be a priority in the budget that's adopted by the board to, are we making the minimum payment, or are we going to dedicate more resources towards, you know, additional payments? With an $8.9 million fund balance in your general fund, I can't tell you that we don't have the ability to make additional payments, but I think the real, you know, the real decision comes down to, and I think you're having that discussion now, it has to be a priority to address these liabilities. I took a very strong position back in 2012. You currently can address this with, you know, a bond issue, both and to include the OPEB. And the main reason for that was with our increasing payments to the retirement system, we always come back to, when we're looking at adopting an annual budget, you have a lot of priorities. There's a lot of demands for those dollars. And, to this point in time, we have, as a county, decided to pay that, just the minimum payment. Assuming that MERS has us, and I'm not going to be critical of MERS, but assuming that MERS has us on the right plan. I mean, they have the experts that are determining whether, that 8% return is a valid assumption. And, I think to some extent, we have relied on the plan that they've had us on. But as you see, that we're not making any progress in having a better funded position. So, I've been somewhat, I certainly don't want to beat Tony up, but, we have talked to MERS in the past. Chris was here in January, and, I think that's still a concern that I have. I mean, does MERS really have us on the right plan? Every year they get to redo the numbers. We get a actuarial evaluation.
And I honestly, I agree with you, Dean. I'm hearing that we have 6%, we're earning 6%, and you guys are figuring us at 8%. There's a 2% gap here. Why aren't we getting a bill?
There is something that must be understood here, is the 6% is basically the recognized rate when you take in the 10-year smooth. That is very different than the performance of the portfolio.
Okay.
The portfolio has performed in 2013 6.68, 2013 15%, 2012 11.39, 2011 only 2.29, 2010 14.43, 2009 17.31. The 2008 was when we had that big loss of 24.81. The thing that we have to understand is that the portfolio's allocation mix of what we're investing in is designed to do a certain task, and it's doing exactly as it's designed, and that is to have downside protection. So when you would look and say, well, yeah, we did lose 24.81 in 2008, there are many other indices, averages that you can look at that lost much more. So we primarily protect from downside, but we also are able to participate in that upside. And so the performance of the fund is doing as designed, protecting the dollars that you're putting in there. But what we're seeing here is because we have a funding mechanism that smooths out these gains and losses so that you don't have great large spikes in one year because of a 25% loss in the market, that we smooth that in, because the difference between what you have paid in 2007 or 2009 to what you would have paid in 2010 would have been very large. That smoothing was a very effective tool to allow our municipalities to move through that great loss. It's not painless, but it was out great pain in 1 year. And so let's not confuse the performance of the fund with the funding mechanism, which is smoothing those over 10 years.
Yes, Dean.
Just one last comment, and I know that you all probably have, or some of you have comments, but I do want to say that MERS has worked with us. Obviously, take full responsibility. I was the one that made the request to freeze the payments for 3 years, which was subsequently approved by the board, but that was primarily because we were trying to deal with a recession, and we took significant hits to our tax base 2 years in a row. MERS has worked with us. The smoothing that you're doing of those losses in 08 and 09 have helped us tremendously. But on the other hand, we're relying on their experience, their investment professionals, and I want to close with just this. I think they've expressed a willingness to work with us. They came up and talked to us in January. We do need to work with them. I certainly am not saying or making a case that we need to pull out of MERS, because I don't think that's the solution here. And please keep in mind that we will not pay down these liabilities in 1 year. This is a, we're currently on, I think, a 14-year amortization.
Correct.
Going down to a 13-year amortization next year. And that's part of my, we are on a plan to pay down the pension obligation. We don't seem to be making any progress
That's my
on
frustration.
that plan. And I'm not against making additional payments. I do think we need to do that. But we need to work with, obviously, our auditor, Steve, and Tony from MERS. And it's there. We were presented with some ideas in January. Those are still on my list as things that we can do, and, I look forward to what we come up with, so.
Commissioner Crawford.
I just have one comment that might help clarify why they do the smoothing. Because if 1 year, because of a gigantic loss, they might have required us in that year to pay $10 million to account for that loss. And then the next year, only require $250,000 because we gained. So how can you budget for that? You can't budget for that. So that's why they do that, to, as Dean said, to help us so that we know what's coming, and we don't have to budget, for something so huge and then small and then huge and then small. So it is an effective way of helping municipalities to be able to budget. It has to be a known, it can't be so variable. That would have been impossible to do.
I would like to just add to that. New in this year's annual evaluation, we put together 5-year projection scenarios. And they show, we did a 5-year projection based on an 8% discount rate and an annual market rate of return. And we did it for 7% and then 6%. And what it shows as you go through this, it shows on that annual valuation that we're still working through the losses of 2008 through the 2015 annual, the 16 and 17. And then in 2018, we fully expect to recapture, that we'll have smoothed out 2008. And if we don't have any significant downturns in these upcoming 3 years, you should see us move back towards, if not completely, get back to that 8% assumed rate that our current assumed rate is at. However, to help budget, we've done it at that 7%. And so what that says is, well, how do we stop that $2 million loss? Well, if you say, well, let's budget for only a 7% discount rate and a 7% market rate of return, you could see that the annual required contributions for 2014, or for your year 2016, would go up about, if I did my math right, about almost $800,000. We would add.
Annually.
Annually,
Yes.
So we're paying about $4 million a year now, so would it go up to $5 million?
Yeah, your required contribution for 2016, based on the current assumptions,
Yeah.
would be $4.8 million. If we put it at the 7% discount rate and market rate of return, that would go to $5.5 million.
So that's the kind of thing you'll be
So-
helping with, Steve, is advise us about how we,
That's correct.
whether we should do what discount rate we should actually assume.
In
We've
order-
got to take the lead from the MERS actuaries. That they are the ones that are determining these dollar amounts. You didn't engage us to go in and audit the MERS actuary.
No.
Which I think is expensive.
No.
And you wouldn't want to do that. But I have to put some level of trust in an expert who's an actuary that's dealing with MERS.
Yeah.
Regardless of what their numbers come up to, if it's 4.8 or 5.3, the option always exists to put more in. I mean, I think it's best said that everybody's going to have a little bit of pain. And to get these funded, if any one person has pain, that's not fair, so you got to kind of spread the agony and get it fixed. Just
Have a
as my
pain
word.
party.
But I also don't want to leave the impression with the board that this is something that can't be fixed. This is something that over time, you can fix this. And it's something you just have to make it a priority. As Dean says, it's a priority in your budget, it's a priority in your discussions, and you keep an eye on it, and as time rolls on, you will have that obligation funded. And it's going to hurt a little bit.
Well, that, Commissioner Wheelock has been saying that too, that we need to sit down and come up with our priorities, and it makes sense to me. How much money do you have available? What are your priorities? Fund those priorities. And then, you know, some things are going to fall below the line.
That's right.
Right.
And, yes, and
Yeah.
So if this is our
John-
priority, then this
Yeah,
is what we have to
Dean
do.
answered it
And John
very
was
clearly.
going to
It
come
wasn't a
tonight
priority.
and talk about scheduling a planning session.
Strategic planning session.
And that is going to be done very soon.
Well, I want to make sure every commissioner has had their say about this. Is there anything else? Okay, then, we don't need to make any motions or anything, or accept anything. Thank you, gentlemen, so much.
Thank you.
Thank
And,
you.
And I greatly appreciate the fact that you guys you're saying this can be fixed. It will take time. And I'm just going to speak for myself. I want to take some steps towards fixing it.
Great.
I don't know if you have to accept the financial statement.
Do we, Dean?
Do we?
It wouldn't hurt.
I don't
someone make-
recall in the past you.
I would move to...
Sometimes I don't know what to say, but I think
All
that's
right.
appropriate.
I would move to accept the CAFR,
There you go.
the 2014 CAFR.
Well done, too.
I would second.
Yeah. Seconded? Any
Yes.
discussion? All in favor, say aye.
Aye.
Opposed? Okay, motion carries. Good job.
Thank
Any of you
you.
have
Thank you
questions, you have my
both.
cards, so you guys can call me
Thank you.
day or night. I'll be around, so.
And that good job includes Dean, too. He did a lot of
Yes.
It doesn't happen without Dean, that's for sure.
My staff.
Okay, let's see, what's next? I got
Nothing.
a unfinished,
Yeah.
Our added stuff.
unfinished business. We have any?
Yeah, new business.
New business.
New business. Let's do the 911
Yes.
thing.
I had a very brief conversation with Mr. Cooney, and he and I feel that it would be prudent to get a second legal opinion, just to dot the i's and cross the t's regarding whether or not we can indeed spend the surcharge money, even though he has already said we can. So therefore, I would move to authorize Mr. Cooney to seek an outside expert opinion regarding the spending of the 911 surcharge.
Okay, is there a second?
I'll support it.
Okay, I don't know if I'm out of order or not. I think we should either pass or not pass this. I don't want this to turn into a 911 discussion. That could be done at the end of the month. We've all worked hard tonight. So we have a motion, a second. Is there any discussion?
Bob, do you have any comment about this? Because obviously
Yeah.
you've already given us an opinion that said the ballot language allows for the purchase of this equipment.
Well, I haven't quite given that opinion. I know the board tasked our office with offering an opinion about whether the proposed equipment service upgrade from Motorola would be proper use under the 911 Act. And after reviewing the law and considering this, we really feel that this is beyond the expertise of our office, even though from what we have looked at, I feel very confident that this is a proper use of the 911 funds. I still think that we should have an outside opinion given the amount of money that's involved here and the long-term nature of it and the potential for a lawsuit if someone were to disagree with that. We know that Doug Van Essen is an expert in this area. He's done work for this county and a lot of other municipalities, and he deals directly with cases involving the 911 Commission, which is a very specialized area of the law, and I don't think that this would involve a lot of money. Mr. Van Essen has indicated that he's able to prepare an opinion prior to August 4th, which is kind of an important date because there's a big discount if the county signs the proposal before August 4th. He's agreed to have the opinion for us before July 29th. I'm confident that he's going to agree with our opinion, but at the same time, I think for a minor investment of money, probably less than $5,000. I think it would be a good investment anyway.
Anybody else? Okay, was there a motion in a
Yes.
second?
Yes.
Okay, all those in favor say aye.
Aye.
Opposed? Motion carries. Then we're going on to your item.
Oh, the NER, yes, the Nature Education Reserve Advisory Board. I represent County Parks and Rec on that board. Many of you have probably met Tom Vitale from the Conservation District. He is new in the last, 8 months or so. He replaced Ben Purdy. Tom is a real organized bookkeeping kind of guy, and he was put in charge of the NER Advisory Committee and started digging through and looking at paperwork, and we found that the charter, the original charter that created the NER by the county board, has not been followed for many years. So Tom wanted to make sure that we created a list of the people that serve. We created terms for them to follow along with it. According to the bylaws, the County Board of Commissioners appoint all members of the NER, and no one seems to remember a whole lot about that. So what we decided to do was, it's a lovely group of people that meet once a month, and they have a real passion for it. Many of them are former county and city commissioners and employees, and they sit on this board and put a lot of work into it. So what we did was created a list of them, and then they picked staggered appointments, and we would like to make it official. And 2 out of the 6 at-large members chose to have this year be the end of their term, and then from then on, we'll go through the official and proper way of doing it by having them resubmit for reappointment if they would like. We would open it up to people, and the County Board of Commissioners would make the appointments as based on the bylaws. So since I'm the chair of RMNA and happen to be on that board, I said that tonight I would bring this to this board because they would like to have this buttoned up by the end of the month, in which case our full board could hopefully approve the appointments of the citizens that have been sitting on it for many years. And so that's my hope. And I would like to just, I'm going to talk to Chris Kramer about it in the morning. I emailed her real quickly because our meeting is at 4:30, so she was leaving. And I told her I would talk to her about it tomorrow. But since we would like to meet the end of the month deadline, if I could have 2 volunteers in case we do need to convene the ad hoc committee, if that's what's required, to officially go through this. And then we should be done by the end of the month.
Anybody want to volunteer?
It'll be like a 5-minute meeting. Yeah.
I'll
Okay.
I'll do it too.
volunteer.
Okay, I'll do that, and I'll let Chris know. I don't know that it's necessary, but when she goes in to find out, to make sure we do it all properly, I just wanted to have it lined up.
You know what? We ought to volunteer Bob Johnson. He's watching tonight.
I know,
We don't know when he's coming back.
yeah. We would like
You
to
could
get
do
this
it by
done.
television, yeah.
So it would be nice to have this in the database for all of the county appointments like it should be. They'll have official terms, and then people can seek appointments to it as citizens at large that are interested. And the other thing is the city of Traverse City, by the bylaws, is supposed to have a representative, and they don't. It should be the city manager or somebody designated by him. So I was going to reach out to Mr. Colburn tomorrow to see if he's interested in having somebody on there. And that is it. And as far as the bylaws state, as we follow the policy properly from now on, it would be the Parks and Rec Commission that weighs through people, makes recommendations to the full board. So this year, we're just going to,
Wing it.
yeah.
Okay.
And then hopefully we'll have it all official.
Okay, now, is that done?
Yep, I'll go
Okay.
ahead, and if I do need to summons you for a committee, we will do that
We'll
with
do
Chris
that.
Kramer.
Okay, now this is the time for second public comment. No? Okay.
Waving.
All right.
It's on here.
Commissioner committee reports. Any? Yes.
I have a couple of parks ones. I just wanted to report, if you go to our Civic Center, you'll see a giant mountain of topsoil. It is in the parking lot by the pavilion. That is what our facilities management employee, Paul Johnson, was able to get from the new Meyer building in Acme for us to use to spread where Kids Cove was. The dirt will be spread this week, probably tomorrow. It will be seeded, and the process should be done. Thanks to Paul, we were able to, although it was much more than we expected, we were able to save a lot of money by him doing things like that, and we're really appreciative of that. Another thing is the Power Island project. Many of you may have seen on the news. Today, the well drilling equipment was brought over in the early morning, and at 1 o'clock, they struck water on the island. So assuming that all the paperwork goes through with the DEQ and the timeline with Seeds works,
Struck water.
they struck
on the
water. And it was a big deal.
I know.
It was this is a
I know.
4-year project.
And thank you again to Elmwood Township.
Thanks to Elmwood Township. So if this goes well, Seeds is going to be working with us to make the new campsites, and we could be having the new campsites really soon. And that was a really big thing for Parks and Rec. We did meet with our business development team for the Civic Center today, and I'm really excited about some of the ideas moving forward that were coming out of there. Picking a replacement site for a new playground. I really am pushing to have a dog park there, so I'm hoping to get that going.
Wow.
And we're looking at all kinds of things that we can do to create revenue as well. So it was a really successful meeting.
Okay.
And that was good. The very last thing, I just wanted to say that Governor Snyder was here on Saturday. I know that Bob was there along with Christine and Carol, and he, as always, gave an amazing speech. But this year, it meant so much more to me than any of this. And I've enjoyed seeing Governor Snyder for years, but he had his words of their journey at the state of Michigan when he got into office with the pension debt and the OPEBs that they faced. I felt really revived by it. He made so much sense. He said all we needed was a number. We came in, this group of people came in and they just wanted a number for our debt. We found out the number, we made a plan, and in 2038, the state of Michigan knows that their debt will be paid off. And that's all we're trying to do here in Grand Traverse County.
Yes, we
It can
are.
be dramaed up as much as they want and turn it into a reality show, but ultimately, we're just trying to get a number. And one of the things he said that I thought was great was he said our long-term debt in Michigan is a mortgage on our children. And he talked about fixing a broken political culture, how he went into Lansing at a time when morale was at an all-time low for state employees and citizens, and they were able to work together, albeit with a lot of friction, to fight against this culture. And the last thing he did was point out how right here in the state of Michigan, we have the perfect role model for how to get out of pension debt. We have a state that moved its rankings up tremendously fast when you really think about it. So it was very inspiring, and as always, appreciate him being here. And it was very refreshing to be reminded that right in our backyard, really, we have a perfect example of how to successfully make a plan and get out of debt. Grand Traverse County is fixable. That was the number one thing. If the state of Michigan can do it, we can do it here in Grand Traverse County. So it was a very, very worthwhile visit. And if you ever get a chance to see him speak, do it.
Commissioner.
I did have a meeting yesterday with members of Community Mental Health and administration of the jail, and very good meeting. Came to an acceptable agreement regarding treating the mentally ill in the jail and making sure that everybody's taken care of in the right way. And so I will have Carl Kovacs and Todd Ritter come and present the whole plan, public health and safety, next month.
Very
Okay.
cool.
So that's all
Anybody else?
done.
Notices and announcements? I've got one. Dr. Bob Johnson's mom is doing better, and she's in our prayers. Bob, wherever you
Hey,
are.
Bob.
Jacksonville, Florida,
Yeah.
with Mom.
We're not
With mom, and she's
volunteering you
doing
for
better,
anything.
right? That's what
Yes,
that's
he
what we-
said she
yeah.
was, and he's eating.
Do we need a closed session?
Sonny's
Oh,
gonna-
Sonny, yes, sir.
I want to take this time to congratulate Dean Bott and his family on the selection
Oh,
of his
yes.
daughter
Yes.
as the National Cherry.
Now, I had
I
to
think
tell
she will
you,
be a huge ambassador for our community.
I have got to share with you Chris Kramer and Georgia and I at the copy machine when Dean popped out of his office, and Chris said, "Oh, what shall we do in the presence of the royal family?" And we curtsied. And I tell
And he
people that.
probably blushed.
But
And he was-
I truly believe that Danielle will be a fabulous ambassador for our community.
But if she's the queen, what's that make him?
Your finance director.
Probably makes him like I am old.
Very
Well,
cool.
Thank you.
Yeah.
Thank you.
Anything else? All right, we're adjourned.
Thank you.